Good morning, everyone, and warm welcome to our today's webinar, part of the Sorainen series titled Helping Clients Succeed in the ESG Transition. I am delighted to open this session and to see your interest in the EU ESG policy. Let me introduce the agenda. In a moment, my colleague, Agita Sprūde, Counsel at Sorainen, Latvia, will walk us through key regulatory updates, covering the Corporate Sustainability Reporting Directive, the EU Taxonomy, and the Corporate Sustainability Due Diligence Directive. Following that, Caroline Simona Lauritz from the Sorainen Tallinn office will share insights into the emerging field of ESG litigation. This is no longer theoretical, it's happening, and it's reshaping risk management and the way stakeholders act. Throughout the webinar, we encourage you to engage actively. Feel free to use the Q&A tool to submit your questions. We'll do our best to address them during the dedicated session at the end. But before we dive into the details, allow me to briefly overview the European Commission's current ESG agenda. Each autumn, the Commission outlines its strategic priorities. Let me highlight a few key initiatives on sustainability and industrial transformation mentioned in the so-called State of the Union speech delivered by President Ursula von der Leyen in September this year. First, the battery booster package. Recognizing batteries as a cornerstone of clean technology, especially for electric vehicles, the Commission announced a 1.8 billion euros investment in battery production. Second, the grids package. With over 70% of the EU's electricity now coming from low carbon sources, the focus is shifting to infrastructure. The Commission is pushing for grid modernization and faster permitting. Third, the Circular Economy Act. This one aims to create a unified market for waste, secondary materials, and reusable resources. In parallel, Commission, of course, continues to advance a series of legislative packages informally known as the omnibuses. These aim to simplify and harmonize regulations across sectors, making it easier to do business while still embedding the sustainability. You may already be familiar with some of these, and my colleague Agita will touch on a few in her presentation. One particularly noteworthy update is the suggested second postponement of the EU deforestation regulation. Originally set to apply from December 2024, then delayed to December 2025, the Commission has now suggested to push it further to December 2026. This reflects the complexity of implementation and the need for readiness across sectors, across global supply chains. So ESG is evolving fast. With that, I invite you to stay curious, and I'm pleased to hand over to my colleague Agita Sprūde, who will guide us through the key sustainability updates. Agita, the floor is yours.
Hi everyone, and thank you for joining us. As Vitalija said, we are in the middle of a rather significant change and a lot of uncertainty. And the aim of my today's presentation is to highlight what has been done this year and where we are heading in the future. So, in essence, everyone is talking about the omnibus package, the simplifying EU sustainability, but what does it mean? There was Omnibus 1, Omnibus 2, then there were some big changes in July and even bigger changes now in October. In essence, when Trump came to power and Europe had to respond to retain its competitiveness, Omnibus was introduced with the aim of simplifying the administrative burden and regulatory requirements, meaning cutting the red tape, whatever this means. The Omnibus proposal also wanted to align requirements between CSRD taxonomy and CSRD regulations, and thus make it more comprehensible and easily understandable for the reader to understand what the companies are talking on in their different reports and what data should be collected for those who prepare the reports so that there is not double work to be done. It also introduced the aim to significantly reduce the scope of firms who are subject to the different reporting requirements by 70 or even 90%. But then it was just a proposal, the proposal that is like not yet in force, and therefore it created a kind of gap between what companies are expecting that they will have to be doing and what is already required by law. As some countries such as Latvia, Lithuania, and if I remember correctly, also Estonia had already transposed CSRD, the work on CSRD had begun on transposition. So all that was put in stop with the Omnibus proposal, but still those already adopted legal requirements remained in force. So in June, European Council proposed further agreement regarding simplification, building on Omnibus package. And in July, there was a quick fix delegated acts adopted to ease reporting burden for the companies that had already started to collect data to report for 2024. It all came down till October, where recently, finally, the Parliament Judicial Committee voted on the compromise reached. There was a major discussions in the European Parliament between different parliamentary groups, and agreed on the major simplification of the packages. And it is expected that this week the trilogues will start on October 24, with the aim to be completed by the end of this year or beginning of the next year. And once they are completed, it is expected that the binding regulation will be adopted, and finally some clarity on the applicable regulation will be known to all. It is still possible that in trilogues there is changes on the mandatory requirements currently introduced and proposed, although given the current agreement between all major political forces and institutions, it is rather unlikely. So what was adopted and how does it differ from previously? In essence, those concern few key metrics and lots of small details. For example, the employee thresholds have been raised significantly. The turnover threshold has been raised significantly for all these legal acts. So the scope of affected companies within the EU has been reduced significantly for all CSRD and CSRD. And the timeline for when the reporting should begin for those who remain in scope is also being postponed. So in essence, lots of you who already had prepared or had started work for CSRD are likely to be exempted. At least I know that quite a lot of Latvian companies who were in the scope in the wave 3 to be reporting now may be exempted. But still, we are in this situation when the regulation requiring reporting is still binding, whereas all this is on the proposal stage. So let's look into more detail for each of these legal acts and what do they change and what is expected. So for CSRD, the aim is to make the reporting easier and more comprehensible and more voluntarily based and not mandatory data point based. So before, the companies had to comply with 2 mandatory ESRS standards and then a few voluntary standards chosen after completing the double materiality assessment. Now with Omnibus, the voluntary sector for sector-specific standards, they were decided that those are going to be voluntary, and small and medium enterprises can rely on other standards. And also it was, as I said, postponed for wave 2 and 3 reporting for 2 years. In July, there were introduced flexible data points, meaning that the firms were allowed to prioritize material ESRS data points and skip non-critical scope 3 emissions and avoid penalties for incomplete data if the efforts to collect those data were documented. In October, the Parliament approved the reduced scope, reducing it to 80-90% fewer firms, and made the sector-specific ESRS standards voluntary, and limited what can be requested from small and medium enterprises. It also added quantitative focus and reviewed clauses for potential future expansion, thus aligning this report with data to be collected for CSRD regulation directive. Sorry. In essence, the aim was to make the reporting to be more voluntary and more suitable for different types of businesses and less formalistic and cumbersome. Still, double materiality assessment is required, although it might be in a more simplified manner, and still, lots of companies are required to prepare the full assessment. So all this is tied to also changes in the EU taxonomy, which provides a classification and terms to be used in the reporting. If you remember, then, and most of you know very well, because taxonomy regulation was one of the key tools on which to build the report. The taxonomy classified which is considered sustainable activities, provided that criteria for no harm and different safeguards, as well as criteria on how to determine whether or not some activities are considered as sustainable activities. So in Omnibus, it aligns scope and provided that it is voluntary to follow taxonomy for non-in-scope covered firms. In July, it simplified what does it mean, the no significant harm criterion. It allowed also a partial alignment. It reduced data requirements for capital and operational expenditures, and it provided that those requirements will be effective as of 2026, with a possibility to postpone it until 2027. In October, taxonomy regulation was not really touched, so there were no major changes, but it reinforced the voluntary approach for those reporting, subject to the reporting requirements and willing to do the voluntary reporting. So let's move to the third regulation, which is the CSRD, or Corporate Sustainability Due Diligence Directive, which required risk-based due diligence on environmental and human rights impacts, and provided that for large companies, transition plans with compliance with Paris Agreement aims have to be made. Well, CSRD in practice was the directive that everyone were afraid of, as it provided an EU-wide civil liability proposal, included a harsh fine similarly to GDPR regulation, and provided lots of data collection obligations up through the value streams. So with Omnibus, it came down also to cutting down its scope. Now it applies directly only to mega corporations, more or less, as the thresholds that are now imposed are for companies who employ more than 5,000 employees and who have more than 1.5 billion turnover in the EU, or EU for EU companies worldwide. It also stated that you no longer have to do the risk assessment throughout all your value chain. Rather, you have to focus on tier 1 partners and those and others only if credible risks to the environment and human rights are persistent there. It also cut out the EU civil liability regime and capped the potential fines at 5% of group level turnover. And also, similarly as for CSRD, postponed the transposition from July 2027 to application as of 2028. In October, basically all this was affirmed, but it also provided that those thresholds are like now permanent, and it added stricter rules for explaining the data gaps, still not in, and provided that companies that could not collect sufficient data but have applied reasonable effort should be protected from the harsh penalties. So in essence, that are the key requirements, and with that, most of the companies in Latvia are exempted from at least CSRD. However, it might be that lots of you are still going to receive the information requests from your business partners who are in the scope, and thus it would come down to the collection of appropriate data. But for that, we also have rather good news from the European Commission, meaning that with the October changes, a new thing, a digital portal was introduced, and digital portal portal is a centralized digital portal to be launched mid-2026, which will contain templates, guidance and tools for CSRD, ESRD standards, CSRD transition plans. It aims to enhance the support for small and medium enterprises and integrate it together with the broader EU digital package, which also is aimed to simplify the administrative burden of the businesses. And in that sense, it might be a useful tool. Hopefully, it will come down and be implemented in time. So to wrap up on and to provide key takeaways for the next steps. In essence, it is essential to keep track what is being done with the legislative process in the EU, as for now we have certain clarity, but as I stated, like for example, for the reporting deadlines, the local national laws still provide a mandatory reporting, as the regulation so far that is intended with the omnibus simplification package is not yet binding. So therefore, the companies who were, for example, a typical mid-size company, which previously qualified as a large company under Latvian or Lithuanian or Estonian law, having 250 employees, more than 50 million of turnover, and who was in a scope of Wave 3 CSRD directive and had to prepare its report, started already, most of them started already preparing pilot reports. So for those companies, if the legislative package is adopted as it is, they may no longer be in a scope, so all the reporting, if they wish to continue, will be voluntary. And perhaps from what we see in the market, we invite to keep for the companies to keep doing the good job of collecting data about their business and its impact on sustainability, and keep reporting at least to some voluntary extent, as we see that companies who are doing the collection and reporting might receive more beneficial terms for and ease to attract green financing, or still their larger international partners might prefer to collaborate with the companies who can collect and show the data. And thus, we are likely to have more clarity at the beginning of next year. And with this, I'm saying you all thanks for your attention, and let's keep in touch to see how and when this regulation was adopted. Thanks.
Thanks a lot, Agita. I truly believe that, for CSRD, the focus on Tier 1 partners, for CSRD, the materiality threshold introduced will make life easier for the companies, and perhaps, on the other hand, will incentivize to further report on a voluntary basis, since the exercises might be, more doable. However, despite the one step forward and two steps back in the legislation, I truly believe that all these new ESG related regulations changed the way of thinking, changed the way of thinking of NGOs, of companies, and also of citizens. Therefore, we cannot, rewind this changed way of thinking, and we can see that the ESG litigation is emerging. And I invite my colleague Caroline to share her insights on this topic. Please, Caroline, the floor is yours.
Good morning, everyone. My name is Caroline, and I'm going to give you an overview of a landmark climate case that has only not entered us in a new era of climate litigation, but also is a valuable insight into the obligation of states regarding climate. And I'm also going to talk about the implications of this case to corporate liability and also risk management. And the case helps us to understand what is coming next and what to be aware of. And it also gives us a glimpse to possible outcomes of future potential climate cases and what the outcomes might look like. So where are we today, or where were we before the landmark case? The case I'm going to talk about was the first international discussion that focused on climate matters, and it had never been discussed whether states can be liable for climate changes before. And therefore, climate-related court cases have rather been rare at the international level. Usually, the cases are binding to the states that are, for example, sued. But this case is describing the liability of all the states. And the reason behind that can be that legal actions in climate matters are only possible in very limited circumstances. So on the one hand, climate cases affects anyone, but it's as the impacts are uniform, it's really hard to take the case to the court, and usually only states by themselves or climate organizations are successful. And there has been uncertainty whether states are accountable in climate issues. And before the case, each country usually sets its own goals. And for example, European Union has its own targets, but those are binding only to the member states. And also, if there are some climate treaties, these are also binding only for the parties. So here's a new era of international climate law. International Court of Justice made an historic advisory opinion. And International Court of Justice is a principal judicial organ of the United Nations. Although the decisions are not binding, they are significant for example, interpreting in-state laws, or also drafting national legislation. And how this case got to the ICJ, it was initiated by Vanuatu, a very small Pacific island that's nation felt the climate change by themselves. So there was a sea level rise that they felt. And as I previously mentioned, it's really hard to take the climate case to a court So a student organization from Vanuatu managed to convince the state to go to the ICJ, and it brought unprecedented global engagement. In December 2024, there was a first round where 91 countries submitted written statements, and then in the oral hearings, there were 97 states and 11 international organizations. Their thoughts were, of course, largely driven by their political agenda, but the diversity and different perspective allowed for a deeper analysis of the problem and help to analyze the key challenges for different countries. And although not all world countries participated, the opinion still is a global precedent, as many countries can use it. And the key legal questions that needed answers were that do states have binding obligation under international law to protect the climate even outside formal duties? For example, to limit greenhouse gas emission with future generations in mind, and can failure to act or even some acts result in legal consequences? And what ICJ found, the decision is very fresh. It was published on July 23rd this year. And what the court found, one of the most important statements is that states have obligation to combat global warming, even if they are not party to any international climate agreement, for example, the Paris Agreement. And according to the court, this duty comes from customary international law. And from that comes the point that even inaction can lead to consequences. And this brings us to the fact that climate responsibilities are now considered universal and binding for every state. And the practical impact of the decision is that states must use all available measures to avoid any kind of significant environmental damage. And for example, in the past, or even right now, the polluting activities are taken to the lower income countries, but based on that statement, it could not be possible soon, as states must work together to prevent and mitigate the climate harm. And the court really gives us a clear message that protecting environment is a shared mission for all of us. And one interesting dimension is that ICJ told that right to clean, healthy and sustainable environment is a human right. So it's essential for safeguarding life and health. It was uncertain before whether climate can go under human rights, but now the court has declared it, and this could open the door to popular claims, which means that individuals or groups can easily challenge state inaction, and climate cases could increase because of that statement. And where it brings us, what to consider after the ICJ decision. First of all, governments and states must ensure that businesses operating within their territory must take steps to prevent environmental harm, and failure to do so may result in state liability. So it can give states obligation to, for example, come up with new climate related rules. So therefore, there probably will be new climate related regulations and obligations for businesses. While currently each country can support its own companies and avoid stricter rules and restrictions to not harm local entrepreneurs, but soon this may not be possible in the future. So businesses must prepare for increasing restrictions and liability. And also this comes as to the fact that corporate leaders must balance national climate goals and shareholder interests. And if they are not able to balance their actions, this can, and it harms the profitability, they can be personally liable. And due to the decision, the risks are rising, and the risks are mainly coming from climate-related litigations that are probably going to increase. And due to the facts, it is projected that liability insurance demand is going to grow as businesses need more protection against possible sanctions. And the climate regulation tightening is no longer hypothetical. We could say that it's inevitable, and companies who adapt early will gain a competitive edge in involving legal landscape. And that's all for me. Thank you.
Thanks a lot, Caroline. That's very interesting, and you know, when listening about the famous ICJ decision, this somehow reminded me previous case in Estonia, the so-called Fridays for Future versus Eesti Energia case, where Fridays for Future, you know, challenged shale oil plant construction permit. And there, you know, the Estonian Supreme Court also said something, you know, similar, that the legislator has a constitutional duty, you know, to limit greenhouse gas emissions based on the best available scientific information and Estonian international obligations. Of course, ICJ decision is even more, you know, powerful tool and signal, and what you said about active participation of the countries in that case really shows how important it is, and how, you know, all governments understand that their, you know, aim to enhance competitiveness should be carefully balanced with the climate protection goals. Maybe another take is the rise of NGOs. To me, I always believe that NGOs, you know, are very strong in the world, and they will become stronger and stronger in our region. And you know, the businesses and the governments cannot underestimate, you know, the power of the active citizens and the NGOs. So with that, we come to our Q&A session. We had a couple of questions on CSRD that Agita already answered in the Q&A section. We also have a question from participant on the methodology that should be used to collect emission data from manufacturing facilities. And well, this one is a complicated one, perhaps we will not be able to provide a straightforward answer in the webinar. Of course, there are, different methodologies how you allocate emissions to individual products. There is this method to divide emissions based on the mass of each product. There is a method to divide emission based on the market value of each product. Also to use various, engineering models, simulate energy and emissions per product using various parameters. Of course, our general answer is if we speak about any public reporting, most important thing is to substantiate the methods chosen in a proper way. Now we have another question. Will green energy certificates be as valid as carbon credits issued by EU in the EU ETS system? I think that no one from our presenters will be ready to answer that immediately, but please feel free to write the question via email, or we will, check who provided the question, and we can, revert via email. Use your registration link to provide that question via email. We had some questions provided via email before the webinar, and allow me to voice some of them, and maybe first question could go to Agita. One of our participants asked what are the most crucial points that need to be included in the climate or ESG transition plan. Agita, could you please take this one?
Thank you, Vitalija. Well, the climate transition plan is required under CSRD directive. Thus, the directive and the standard also provides some framework on how to formulate those. And from what we have seen in practice being done, and now from the regulation, from the directive, the key metrics, the key points to be included is the very precise targets and metrics. You have to include a time-bound greenhouse gas reduction goals. For example, absolute scope 1 to 3 emission targets for 2023 and 5-year steps by till 2050, which are based on scientific evidence, like which are verifiable based on scientific evidence, and which allows to check and verify the data provided. You have to provide decarbonization levels in the company and the appropriate resources, how you are going to achieve those. For example, what are going to be technological investments, supply chain shifts, what are your financial plans, CapEx, OpEx allocation, and what are the implementation timelines. Then there is aspect of governance, whether what will be the body implementing and supervising, what would be the board management roles in oversight, and where the annual progress will be reported. and whether this progress will be included in the CSRD disclosures. Then, of course, there is this, it has to be aligned and compatible with EU taxonomy for sustainable activities, and it is the best practice is to implement also to include it in your double materiality assessment, where you evaluate the impact and the risks arising also from implementing this climate transition plan. So in essence, it sounds easy, but when you put on a paper, in essence, it's to choose clear criteria that can be verified, checked, and follow scientific method, and have appropriate amount of resources allocated and planned for achievement of this goal.
Yes, thanks a lot, Agita. And we have one more question submitted via email before the webinar, and it is, you know, in a way connected. Our participants were asking, with mandatory CSRD reporting timelines postponed for many entities, what are some strong examples of voluntary ESG disclosures or transitional reporting practices, including frameworks or tools companies are using? And on this one, I would like, you know, to mention one great example, in my opinion. This summer, the ESMA, European Securities and Market Authority, this is EU financial market regulator and supervisor, published their first climate transition plan. And under this plan, ESMA commits to reducing its gross greenhouse gas emissions by 15% in 2027 and by more than 30% in 2030 compared to 2023. So what ESMA says in their climate transition plan, they say that they aim to reduce the carbon footprint in its operations, particularly in relation to staff business travel, energy use, and food consumption. And some, you know, of the instruments to achieve that is to introduce an annual greenhouse gas emissions budget to manage the emissions from air travel, optimizing premises floor occupancy during certain periods of the year to reduce energy consumption, and also implementing incentives to shift to lower carbon practices in the purchase of goods and services. So this is really a good example, in my view, that, you know, all market participants who, you know, still are planning to report transitional, well, the practices, transitional practices could take a look into. Of course, some, you know, other market players like Unilever or Patagonia, they have good examples of climate transition plan, but like ESMA from the European regulator to take a look into a good example is a great idea, in my view. Okay. What else here? If somebody is jogging or walking while listening to this webinar, I will voice one of the questions in the chat and read the answer already provided. Our participant asked if the CSRD is delayed by 2 years under the Stop the Clock directive, do the same delays and thresholds also apply to EU taxonomy reporting, especially for corporate groups? And the answer is yes. The CSRD stop the clock delays apply to EU taxonomy reporting as well, because the taxonomy disclosures are integrated into CSRD reports for the companies in the scope. So if the corporate group is part of wave 2 or 3, its taxonomy reporting is delayed, similarly as CSRD reporting is delayed. What else? We had a question before the webinar provided via email, and I would like to direct this one to Agita again. What is the experience with suppliers who are not themselves entities in the scope of the obligatory reporting or due diligence requirements, but from whom data is still required? Does this create obstacles, and have there been cases where suppliers had to be changed due to ESG non-compliance? Agita, what's your experience?
In essence, yes, similarly as any requirement where information is requested from someone, be it sustainability, be it anti-money laundering requirements, and so on. The small and medium enterprises that we work with also receive quite a lot of questionnaires to be filled in to be provided data, and there have also been some audits with the clients to check whether or not the provided data are compliant and how the processes run in practice. So that's nothing to be too afraid of, but of course the data collection, especially if you have multiple clients who request information which is similar but not the same, creates the administrative and cost burden. And there are some who are very proactively doing the voluntary collection data, almost like for voluntary reporting, and who can obtain and gather and provide this data easily, but that also requires some administrative resources to be allocated to deal with this. And then there are some who just consider sustainability to be overhyped, and who state that they will not provide anything. And we know also in Latvia cases where the suppliers have been changed to the ones who can provide the data. As for a large company, they might have in-group requirements stressing the importance of having verified suppliers. I think many of you have received also 10-page anti-corruption guidelines and codes of ethics that need to be signed, and similarly it is with the sustainability related disclosures. Statistically, where we looked in Europe, approximately 25% of suppliers have been changed, at least in the business surveys, due to sustainability related information disclosures and whether or not the information can be obtained and verified.
Yeah, great. Thanks a lot, Agita. And stay with us. You are a dispute resolution lawyer, besides being an ESG lawyer. So are you aware of any, actual disputes in Latvia between the small or medium supplier and a big corporation due to, terminated cooperation due to ESG concerns? That's one. And second part of my question, what are your views on the ICJ decision introduced by Caroline? And do you believe that the ESG litigation will increase?
For sure, and currently I'm not aware of the supplier disputes as due to premature termination for the grounds, as well, the culture in Latvia is not too much going into disputes, so the companies operating here usually evaluate the risks, whether the agreements allow for such termination or not, and then to engage. However, I know one case where a minority shareholder has brought a case against the company for non-existent climate transition plans and lack of sustainable activities. So that case is not public, and but still it's a very interesting to see first minority shareholder activism also appearing here in Latvia. And for that purpose, I think that this is still going to be increased as the generations changed, and we see that like those who enter the workplaces and start to accumulate the capital are concerned about the climate goals and climate change, and require the companies to take sustainability in direction. So we might see also, when this culture matures, more disputes to come.
Thanks a lot, Agita. So our time is coming to the end, and with that, I would like to wrap up. If you feel that your question remained unanswered, feel free to contact via registration form via email. We will be happy to answer. And thanks a lot for your interest, for participation. As a final thought, I would like to stress once again that, well, in our view, you cannot erase and rewind this overall increased focus on climate change and on sustainability risk management. We see that ESG topics are there in the LDDs in M&A transactions. We see that companies, still need either voluntary or obligatory disclose sustainability-related information, or to substantiate that certain project or activity complies with EU taxonomy, hopefully simplified. Also, there are other important, interesting topics, such as Women on Boards Directive requirements that touches quite many companies in our region. So if you have questions, feel free to contact us. Thank you once again, and have a productive rest of the day.